The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Can everyone see my screen and hear me? Great. All right, let's go ahead and get started. The purpose of these Beginner Circle webinars is really to help you guys get, especially the new folks there, get acclimated to Elliott Wave, ask questions about Elliott Wave, applying Elliott Wave, ask questions about where to find things on the site, what you could find in different services. And we try to answer some of those questions also as we go through just a broad overview of where we are in the different counts for the things that are covered in the market section. So as Avi posted the other day, something that Garrett and I have been leaning to for a little while is that really our best bet at being getting a fifth wave up for one more high really relied on holding the June low. And not just holding the June low, but we were really looking for this to hold as a fourth wave and get a fifth wave up to get 5 waves up off that June low. And once it broke under support in the 4,000 region back in August, it started to get more than a fourth wave. We gave it a little bit of potential for this to be an ABC down into the early September low as wave 1 and wave 2 and an ending diagonal. And it turned up from that early September low also. But then when it broke down under that in a more aggressive drop and went on to make new lows, it looks a lot more like 5 waves down as a leading diagonal for this larger A wave in the start of a much bigger correction off of a more significant top to the market, which completed the primary wave 5 off of the March lows. Now, it's not completely invalid as a fourth wave. It could count as a WXYXZ triple combination pattern, but it is very, very large in relation to what would count as the wave 2, or even if you count this as the wave 2, and very, very deep fib-wise. So reliably speaking, and Elliott Wave works best is trying to look at what the most probable path is, as well as eliminating those things that are least probable. Relying on getting a fifth wave up is not very reliable. And even if we were getting a fifth wave up, then it certainly has to hold the October lows. And so far, we have clearly only a 3-wave move up start. So anything off of that low would be relegated to being some sort of leading diagonal, or maybe the entire thing would count better as an ABC for a fifth wave if it were going to get it at all. So looking for the corrective structure that we want to see for more of a B wave bounce is the more prudent method, more prudent approach. There was a question from Robert asking to explain the significance of colors. I try to use color coding to imply some other information as much as possible. I don't know if that is the same for Avi's color coding, and I think Mike tries to match Avi's color coding. I use as a baseline, I have black background charts. I use white labels whenever I can, and those are usually what's locked in place to the larger degrees. And then sometimes I'll show some variation within that larger structure by putting a few notes of some other subwaves at other colors. So here I have the note for a circle wave 5, which is an alternate of this circle wave 5 that's snapped in place at the January 2022 top, to note that that could be an alt higher high of this one, but it's faded to dark green, so I don't really consider that very reliable. Also on this chart, I have a yellow circle A wave here. This is just for emphasis that this is starting a larger degree corrective pattern from this big major topping zone. So that's not really a different count as an alternate. But I do have this alt red B wave because 5 waves for the A wave is not always the most common. And we were counting this as an A, B, C move down. and we have a 3-wave move up that was pretty substantial in size. So not really the most reliable. I mean, just as easily counts as the 3, 4, 5 as it does an ABC down and then the B wave bounce, and then a start to a C wave to the downside. So this would be targeting kind of this same lower 2800 region as a wave 1 and working on the wave 2 bounce to the C wave down. And so I have that on a different tab. I have that more fleshed out so that you can see all of that alternate structure. But I try on some of my, on as many counts as, on as many charts as possible to just kind of convey some of that without crowding it with showing multiple paths. So the ideal that we want to see here that we'll zoom in on in a minute is holding a B wave consolidation inside the A wave and a larger ABC up for a B wave bounce off of the October low. Now this A wave and B wave and C wave up could be just a larger wave 2 in that red 1-2 start to the downside, and any failure to hold support in the 3650 to 3600 region could mean that we are starting a third wave down in the red count already. But again, the first move off of this high was a corrective move with a B wave bounce on the Fed and then a reversal right after the Fed. So looking at this as the corrective structure inside at least more of a bounce is more ideal. We can delete that purple. The purple was if we were going to hold as a fourth wave and get a fifth wave up, extended further, and getting closer to that 4100 region would be more in line with all of this A wave a little bit sooner in a more direct move, but filling out a bigger A, B, C flat, and then a bigger B and a C wave was always the greater ideal. So hopefully that kind of gives you a little bit of structure. So here I also have a faded yellow B wave here, and that's because this ABC move up would be a 50% to 618 retrace already of this entire A wave down. So it's possible that this, instead of being ABC of just the A wave in this wider and higher flat for the parentheses B, this could be all of that B wave. And it could also be all of the wave 2, even if it isn't as bearish as all of the parentheses B wave or all of the wave 2. Even in the primary white count here, we'd still be looking for a pretty decent fade back towards the same lows as the October region to fill out that wider flat. So when I do show alternate counts, I try and limit those as much as possible. So like on something like this, I'll just hint at that with one little note there, but try not to crowd what my primary expectation is by having a lot of red notes on there, and I might show that in more detail on a different chart so it doesn't get in the way. But also I look for those points where the patterns overlap. So there is an immediate risk here of starting a third wave down, but as I said, the first move down here was corrective, and even though this could technically count as 5 waves down, enough other charts that do have a similar risk of starting that C wave off of the August high look more like an A, B, and a C wave structure. And so ideally more of those are going to get more of a wave 2 bounce. And even if they are starting the third down, it should be an ABC drop as that wave 3. And so this might be an A wave and it tries to bounce to head up to the start of a C wave, but then turns down from a red parentheses lowercase b down to here, and then another bounce and then down. So now let's look at the, well, let's look a little bit more at the larger degree structure of what we are expecting. So if this is the start of a larger correction, then most likely it's the start of a supercycle degree fourth wave. So that goes all the way back to, I don't have all of the data here on my actual chart, so it's kind of brought over from data that Garrett has on his chart, but it goes all the way back to the 1932-33 low for the supercycle wave 2, which included the drop in 1929 and then a B wave bounce, and then it petered out. Not much of a B wave bounce, but not much lower for the C wave, because most of that drop was a really sharp 1929 crash. So off of that low, we had a cycle, wave 1 and wave 2, into the 1940s. And then from the 1940s, we really had a lot of long-term upside that reached the primary wave 3 of that cycle 3 in the 1969 top. Moved pretty much sideways for the 1970s. If you look at a chart of the Dow, this actually counts better as the wave 3, and this counts as an expanding triangle. That count works just as well here as well in the SPX. And then we get to our cycle wave 3 top back in the 99-2000 at the tech bubble. And then a big expanded flat, very slightly expanded, but it did make a nominal higher high in 2007 for the B wave, and then the financial crisis of 2008-2009 being the cycle degree C wave of that, or the primary degree C wave of cycle 4. So the correction that we're looking for the super cycle wave is 1 degree larger in magnitude than the big ABC flat that we got from 2000 to 2009, 2008, 2009, and is the opposite consolidation of what we saw in 1929 to 1930s. So we do think, because of various guidelines that Elliott wave has, for alternation and for, the structure that we should see, we do think there's a very good chance that this B wave at least attempts to make a higher high. But that should be sometime in the middle of the 2030s. I think, the cycle degree A wave down is going to probably take us down below the March 2020 lows as a larger primary ABC. And then we can have a really, really big B wave bounce that this part of the move could actually end up taking the longest amount of time off the clock. Again, very similar to the time frames that we saw in the 2000 to 2009. That first move down took the better part of 2 years, but then you have the better part of 5 years to the upside, and then the last move down was very, very quick. So similar to that, this might finish off a little bit sooner for the bigger ABC down, but then the B wave at the cycle degree could take, the better part of a decade, and then this actually is a much sharper drop at the end. So if we look back, there's a question about in terms of when we recognize that the top was in place. And I think it's important to realize that, a lot of us, particularly Garrett and I in stock waves, were looking at a lot of things and very concerned about needing a pretty substantial consolidation from the December and January tops last year. Now, we got most of that move into the March low, and so we're giving that the benefit of the doubt of being the bottom of a fourth and starting a fifth wave up. We got a pretty substantial move off that low, but again, in early April, it couldn't hold a higher level of support to get a fifth wave up, to get 5 waves up off that low. So this is where looking at different degrees is very important, and looking for confirmation at all of those degrees, because at every step of the way, again, even in May or in June, we were giving those the benefit of the doubt of still being an ABC down, even though it was larger than it should have been for the fourth. Both of those got pretty decent moves off the low, but then they couldn't hold higher levels of support to give us 5 waves up. So you're talking about a move off of the June low of 18, almost 19%. We were looking for consolidation, a fade as a fourth wave, and it started to get more than what we needed to see for a fourth, and then dropped down even lower, and then tried to bounce off of that low as the start of a wave 1 and a wave 2, and then broke support again. So we were leaning that way, that the top was in place once that failed to hold reliable support in the 3900s as a wave 1 and a wave 2, but didn't officially make that the operative count until that lower low was reached in October. And then even off of the October, the bias for, that Avi had a more bullish bias that he wanted to see because of the larger magnitude of the implications of a much more significant degree top in place, wanted to try and give that the benefit of the doubt if it could get 5 waves up off the low. So then when we start to look at the smaller degree structure off of that low, we started off with a move that was not 5 waves up. So it was relying on being a diagonal at best. So that diagonal really needed to hold support in the 3,800 region as a 4th wave and get a 5th wave higher to have a better chance of being the start of a 5th wave to a new high. And instead, we clearly only got an ABC up and are working on filling out a corrective retrace for the B wave at the moment. But again, we said that it is very, very important for support to hold in this 3,650 to 3,600 region. So the B wave on the S&P, let me zoom out here a little bit. That is the most common and ideal retrace is a 618. Depending on how much higher the A wave gets and where the B wave holds, that might easily get pushed up closer to the 764. But again, that's not really reliable. And also, if we do get closer to the 50, the 50% retrace, or if that stretches closer to 4,200, where it's in between the 50 and the 618 on this next move up here, then there's a good risk that this is all of that B wave bounce already, and then we start the C wave down instead of getting an ABC retrace for that B wave to hold. So again, I think the shift, the focus, really needs to be on treating every clearly corrective move up, even if it can be still part of a bigger bounce, as potentially all of something that's a corrective bounce, and looking for, the next move down to break support, at least in terms of lightening up your risk exposure and hedging your portfolio. That doesn't mean short everything with targets way down in the below 3,000 and relying on a downdraft to get there, because it can easily hold support and keep going higher. So, but it is a much different focus than looking at support holding from the June low and looking for this to get 5 waves up and hold as a wave 2, and allowing for that to play out. So it does not seem very probable. I wanted to shift a little bit. Well, let's zoom in just a little bit more on the S&P in the short term. I think this definitely got too deep today to really be reliable at all. That was that this is a 4th wave. It looks much more like this is the start to our C wave of the B. But we did have a pretty clear corrective bounce into the high yesterday. And so that was certainly a point where we're urging some caution that even if this was going to get 5 waves up, we were due for a corrective retrace as a 4th wave. It had an opportunity to hold that this morning and then decided not to. So it looks much more like this is the start of the C wave down. So we want to see this fill out 5 waves down. The ES looks like it can be just wave 1 of an ending diagonal. So it might bounce tonight up towards the 3820s ES, which could be about the same. Maybe this opens at about 3820 in the morning, and then we fill out the rest of the 3, 4, and 5 down, and this stretches out a little bit longer in time if it's going to be a diagonal. But S&P cash looks like it could be a little bit more of a direct shot down, and this is already 1, 2, and in the 3rd of the C wave. So that would fill out the 3rd a little bit more, and then get a 4th and a 5th wave down, ideally holding right around that 3647. And then from there, the measured move targets just shy of 4100. Obviously, if the B wave stretches deeper, then the measure move fibs are going to change. And if it drops too much under the 3600 region, then it ceases to be reliable as a B wave, and we start to worry about that red count that we were looking at on the macro tab. Robert says, is there a previous period where the same amount of murkiness has occurred? I think, it's not necessarily that it's murkiness. I think just a lot of us wanted to continue to try and give, as long as there were bullish counts, this was really the best shot of getting a fifth wave up. May was second best, and then we were willing to give it one more strike from June, and at least in terms of a lot of the stock waves charts. Now, Garrett and I are working on a list of some large cap names, that individual stocks that do still look like they are solidly holding a fourth wave. Either they held a higher low in October from June or July lows, or just the lows that they struck in October were still much higher in relative size to consolidations before, and so they do still look like a fourth wave. But again, each chart on its own, and that should all be taken with a grain of salt, looking at the larger context. Now, I did want to jump over and talk about the NASDAQ in relation to the S&P, because I think that the NASDAQ is at a greater risk of being in that red immediate bearish count. Particularly because some of the large cap names like Apple and Microsoft also look like they are very much at risk of that more immediate bearish count. Now, the ideal, even for that immediate bearish count, the 1 and the 2 of the C wave down off the August high, really would look better as a wider flat. So that would be holding the 10,600s here and getting a C wave up into the 12,000 region. The problem is that the S&P looks like this bounce was a B wave and it's starting a C wave down, whereas the NASDAQ looks like this really has to be all of the B wave, because it can't tolerate any lower than this, because this is already an 88.7% retrace, which itself is not very reliable, but B waves do tend to sometimes get deeper than wave 2 retraces. But again, it's just very, very on edge in terms of forming feedback loops. Now, when we look at the equal weight version, which smooths out the exposure to a lot of those much larger cap names, the equal weight version could be at risk of all of the wave 2, but ideally, again, it can be the same B and C wave down of a deeper B wave to the 764, but much under 82. And again, I don't think that the NQ is going to tolerate that, and could certainly start to unravel. But more of a wave 2 bounce up towards the 95 region would be ideal, even if it is that more bearish case. And ideally, we would really like to see more of the tech names also fill out a same pattern as the S&P, because they do tend to pull on each other. So even though the S&P looks much more like it should be getting bigger B wave bounce after 5 waves down for the A wave, there is still the same risk that this is a 1-2 start to a C wave down off of the August high. Andre says, for long-term investment, what would you recommend as a strategy, given that we're on a big ABC down in the super cycle 4? I think that there's going to be a number of opportunities for trading the market in both directions. It just requires you to be a little bit more nimble, and at least just be much more diligent with using stops and maybe shorten your time frames. The NASDAQ. So there's another thing to consider is that the NASDAQ has a different count off of the 2002 low, because it did not make a low. It didn't look like a B wave and a C wave down to a lower low into 2008. It looks more like 5 waves up and held a higher low as a cycle degree wave 1 and wave 2. So that means that the high that we struck in January, or in December in the NASDAQ's case, actually November, was the cycle wave 3 top. And so instead of this being the cycle A wave and then a B wave to a nominal higher high, it looks like we should be getting an ABC down as a fourth wave and then an actual fifth wave up to a higher high in the NASDAQ. And even possible that what we think is the just the A wave of a more normal size correction might even be all of that wave four. But I think, there's a common expression in the markets that it's stairs up and elevator down. And I think that is often the case most of the time. But when you're dealing with a large degree trend change, it's very possible that the larger degree trend move down now is the thing that looks more like the stairs heading down and gets some pretty big beach ball bounces for those B waves. So starting to look for the indicators of which sectors starting to lead the way off of a low to get a bigger bounce, and playing that rotation between the sectors and the key names within those sectors could be very beneficial to looking for the leading moves on those bigger bounces like we're looking at now for a bigger B wave here. All of those moves are going to be pretty significant magnitude moves and can take weeks and months at a time. So there's certainly going to be opportunities to trade in your accounts as we get further along in further out the risk model, in the deeper parts of the cycle degree A wave and cycle degree C waves of the super cycle moves. There is the possibility of some counterparty risk, which is why Avi launched the banking service that's reviewing which banks are safer stores of value. But I don't think you need to be just parked in cash, because there's downsides to that also. All right, let's do a quick comparison short term, looking at the Dow. Again, the preferred count here is also an A wave down and working on a B wave bounce, but a little bit different structure off the low. One, the Dow actually did not make a lower low in October than it did at the very end of September. So that makes it count a little bit differently off of that low, even though it was a near 100% retrace. The higher high that we were counting as the B wave of the B wave in the S&P can actually technically count as a fifth wave up off of the low in the Dow. And that does fit with the potential that we see a few names of the Dow still allowing for moves to higher highs as a fifth wave. That fifth wave would also still be an ABC move up, but we're equally going to be on alert for that to just be a B wave bounce and then to turn down from there. And then last, let's look at the Russell. Russell, I think, also counts best as putting in that primary degree wave 5 top. I have not deleted the fifth wave here because technically it is still valid, especially because this one has to be a diagonal. So this fourth wave, even though it's pretty deep and very disproportionate to the wave 2, a fourth wave of a diagonal doesn't actually invalidate until it drops under the wave 2. Now, that doesn't leave you a practical level for trading, but an academic level for Elliott wave is still not invalidated. So instead of being just a B wave bounce, it's possible that a move up here could be an A wave, and it holds as a B wave and then attempts a C wave up to a nominal higher high. But again, that is very, very unreliable, and more prudent to just look for this to be part of a larger B wave bounce. It is still slightly different than the rest of the market, where it doesn't quite count as well as a fourth and a fifth wave down, although you can apply that same count as well, because it only nominally made a lower low in October. A lot of the Russell names do look like this can be an A and a B wave and are working on a 5 wave up C wave for the wider flat B off of the June low, instead of starting an A, B, and a C wave off of the October low. So again, pretty nuanced difference. In the short term, we're not looking for much difference in the structure. We're looking at the same ABC retrace, which would be either the A and the B of that C in the C wave up for the A wave, and then a B wave retrace, and then the C wave up. And here that could be a little bit stronger in the third and more muted for a fourth than the B wave, the capital minor degree B wave, and then a little bit more muted on that fifth wave up than the C wave of the B, but it's kind of the same ebb and flow. Rob, we can talk about that. That's a little bit more Stockwave specific in terms of short setups or long setups and their short percentage. It's hard to remember to look up something like the short percentage of the float on every thing that we post. That's a little bit onerous. You're welcome to chime in and do that. There's some good sites where you can update that. All right, let's move on to energy. So I think last time when I joined you guys, we talked a little bit about this count in oil, which I think is a little bit forced in the futures count, but this is more similar to what we're seeing in a lot of the energy names. The count that I'm following more closely, I posted the other day that if this was the bottom, and I have this kind of faded gray because I don't really like it and I don't really think that it's very reliable as all of that C wave and does not fit with a lot of the energy names. But instead of this being a C wave, that the whole thing is instead a Y wave down. Let's say I have the Y wave in purple. Oh, again, with the color coding, I use purple for blue is usually reserved to show structure, to imply that something is a diagonal or to emphasize that something is a diagonal. And so when you see those blue counts, just think diagonal and think choppy wave structure. And purple, I usually also use for diagonals, and sometimes it's kind of the alternate or the variation of a different version of the diagonal, or maybe a different part of the structure is a different diagonal. So again, you see the blue or the purple, think choppy, whipsaw type movement, which can be fun to trade if you are prepared for it. So I mentioned the other day that, or maybe even earlier today, that if this was a more significant bottom in oil in the crude futures, because we clearly got only a corrective move up here and we're looking like a diagonal at best here, that it would be a leading diagonal off of the low at best and really needs to hold this 85 region as the B wave in the third to get 5 waves up off the low. I think much more reliable is looking at this as a corrective wave 2 in a possible C wave down, or as the ABC of the fourth wave in orange and getting an ABC move down for the fifth to complete that larger C wave structure and the parentheses C wave structure, or the purple fills out as A, B, and then a diagonal for the C wave as a parentheses Y instead of the C. Now, when we look at USO, that also fits a little bit better as well as a B wave. I haven't updated that in a while, as this bigger A and B structure for that Y wave, which is what we're seeing in a lot of the energy ETFs. I know this isn't something that we usually cover in this webinar, but we are following it very closely in stock waves. Almost every single energy stock, with very few exceptions, looks like an ABC bounce as the B wave in a wider wave for flat off of the July low. So we are very, very concerned about a pretty significant downdraft type move. It might end up being an ending diagonal and only getting down to the 65 region for more of a perfect flat instead of dropping down into the 50s. And that might take longer and fill out all the way into May, but could certainly be a much faster impulse to the downside. Now looking at natural gas, this can still be a fourth wave, even though it got higher, because this would be a diagonal to the downside. for the, I mean, I really consider this the top, even though this is a B wave, got a higher high. This completed a perfect diagonal up for a larger C wave. So that's the point where I stopped following natural gas pretty closely, other than these webinars. I really am not such a big fan of the chart. Maybe if it fills out the rest of the fifth wave of the C wave, I'd be interested in looking at potential small degree structure for a part of a B wave bounce, but really am not going to be very interested in natural gas until it fills out a much larger ABC move. I have been following XOP and XLE at much shorter time frames, looking for 5 waves down in stock waves. So come check out the smaller time frame charts that we've been posting there. Let's move on to the metals. Starting with gold. Gold, let's go to my big macro clean chart. We're looking for a 5th wave up to start at the primary degree off of this larger expanded flat for the primary wave 4. So primary wave 3 topped in August 2020. Big A, B, C structure. Technically, I don't know if it's expanded. We didn't actually make a higher high, so just a regular flat. So far, holding in the ideal support zone, even holding this fan line. And the 382 retrace, which is really ideal, made a nominal lower low the other day, but is turning up pretty nicely. So we know that the primary wave 5 looks like it should really be targeting the 2400 region, and that should be a 5-wave move up. So parentheses 1, 2, 3, 4, 5 at intermediate degree. And we also know that, the approximate proportions that we would like to see based on Fibonacci pinball. And then we also know that we want to see 5 waves up in our wave 1 as an ideal impulse. So when we zoom in on that, we can say, okay, we know where our wave 1 should target. We want that, see that head up to the 1950 region. And we know basically what the proportions inside that move should look like if it's going to be 5 waves up as an impulse. Now, the wrench in the spanner comes in when we look at the structure off of this nominal lower low and see that this move wasn't really 5 waves up, and this looks like more than a 5th wave also. So it really looks like we might be getting an A, B, and a C wave move up for this wave 1, which means that the entire structure here could be a diagonal. And if it's a diagonal, that means we're probably going to get a little bit of a wider consolidation, maybe not necessarily deeper for the wave 2, a little bit more muted of a 3rd, a deeper 4th wave, and then a little bit more muted of a 5th. The 4th wave could also overlap with the top of wave 1 just a little bit, which is normally a no-no in Elliott wave, but is allowed in a diagonal, although we have observed non-overlapping diagonals do happen, so it is not required. But we still do want to see 5 waves up for that wave 1. So looking pretty strong off the low, but again, we don't have that ideal structure to say that this definitively fits in as the start of an impulse. Furthermore, when we look at the silver chart, silver did not make the lower lows recently, and not only did it hold a higher low in October, but it also held a higher low at the beginning of November, and it looks like either an A and a B and starting the C wave up of wave 1 for a leading diagonal for that parentheses wave 1, or could possibly be a leading diagonal for that wave 1. So the difference there, again, I'm using the blue here to show that this would be ABC for wave 1 and the whole structure would be a diagonal. And then the purple variation of that is that if we don't hold this high 4th wave in the 20.7, 20.6 region, then we're probably fading as the purple B wave in the 3rd, working on a leading diagonal. So I can fill in the rest of this. I tend to not put in all of those wave labels all the time and leave some stuff for you guys to extrapolate. So I try to imply it to have less clutter. But if we can fill out the rest of the blue count, we need to hold the 26 or the 20.70 region and get a fifth of the third, and then another fourth and a fifth wave up towards 2314 be ideal, and then hold a wave 2 retrace and then an ABC up for the third to fill out more of that parentheses wave 1. If this whole thing is a diagonal, then this is ABC up for the purple wave 1, the purple wave 2, we want to hold the 1990 region as the purple B wave of the third, and then still head up to that same 2314. The fibs for this, whether this is the third in purple or the circle C wave, it's the same fib measure. So again, I try to imply the most information with the least amount of clutter as possible. So the same structure there, and then instead of fading down as a wave 2, it would need to hold as a fourth wave and then get another ABC move up for the wave 5 of 1, and then would fade in a wave 2 from there. So we can put the wave 2 here. And that structure more or less fits a little bit better with what we're seeing in GDX. GDX, again, unlike gold, did not drop to a lower low, not even a nominal lower low on November 3rd. It actually even held nominally higher than the October 13th low. So again, we can be looking to the same structures off of the low that we were looking at in silver, either a blue ABC up for wave 1 of a leading diagonal for the larger wave 1, or possibly 1, 2, 3, 4, and 5 for a leading diagonal for this same wave 1. So just a little bit higher and then needing a wave 2 again. So hopefully that kind of gives you a good explanation also of how I'm using the different color coding and well as like trying to balance the different subwave structures that we see at those smaller time frames. So this looks like it might be all of that third. Same structure. I'm leading, same structures work here. Again, this can be 1, 2, A, B, C of 3, a fourth and a fifth wave for this wave 1 in purple. So we'll just add a purple wave 1 over to the right and a little bit higher. But was following the blue count first, and so just trying to keep this one, since I'm not zooming in on it, then putting too much of those purple notes would really clutter that a lot. The purple here is of the H is to show that I was pointing out to in stock waves or in the mining stock service, the potential for this inverse head and shoulders to be forming. So you have the W, X, and Y of the larger B wave can sync up with the wave 1 and the 2 and the start of the C wave up, and that gives you a really nice inverse head and shoulders. And even within that, the wave 1 and the wave 2 can line up with this structure here as the 4, 5 of the C to give you a smaller version of inverse head and shoulders. Then you get more of the 3 and the 4, and that can line up with the A and the B wave of this C to give you another inverse head and shoulders before you fill out the bigger one. So really kind of cool things where you can see how the Elliott wave puts that structure into more context. You can say, of course, that makes an inverse head and shoulders. I can see how that fits with the fib retraces in those different subwaves. Let's see. Where should we'll move on to, we can look at TLT. But I think it's important to note that TLT is an amalgamation of the 30-year and the 10-year bonds to try and get a target blend of about a 20-year maturity. So that in and of itself is not an issue, just blending the 10-year and the 30-year bonds, because we can kind of look at those structures. But the other distinct disadvantage is that TLT only started back in 2002, and the 10-year and the 30-year bond charts go way back before that. So even though we can look at this TLT chart and say, well, looking back to the all-time low that the TLT chart made in 2004, it looks like we have 5 waves up and a corrective retrace to just under the 764. So this could be a giant bullish setup. And looking for a measured move. I think you have to be much more careful with that and say, what does the 10-year bond look like? And the 10-year bond, when we zoom out, looks like it is much more in danger of having made a significant top and being the start of a bigger retrace off of that significant top, and maybe only gets a corrective bounce from here. There is the chance that this is an alt 3 or the X wave of the alt 4. So either this is 3 and 4 or the expanded flat like I have it counted here. But all of those, that would still be a corrective structure to the upside if it was going to make a higher high as that cycle wave 5. And off of the low, we really don't have anything clearly bullish yet. We did have a possible 5 waves up and a 3-wave retrace. Then it dropped down to a lower low. Didn't make lower low under that B wave, but not actually a lower low under October. So technically, this is still holding a higher low. So we do have a near-term bullish potential. This is looking pretty strong, actually, as maybe 5 waves up. So ideally, it would retrace back to around 119 and then turn up. But possible even to count this as 5 waves up, and this is all of the retrace that it gets, and it's already trying to start the micro 3rd wave in this C wave up. But again, I think you have to really focus on whatever moves up here being part of something that is just corrective until it's going to clearly hold support after something that can be a much more bearish top here. So would like to see a series of ABCs build into a larger A, B, and C wave up, and then again hold another B wave, and then get a C wave up for that cycle wave 5. But it's really just not very reliable. And then when you look at TLT in that context, then we can say, okay, maybe we can look for a corrective move higher, or a series of corrective moves higher, but just play them as measured moves and not treat this as a significant long-term bullish bottom. So at the very small degree, I would like to see a measured move that still targets 100. Really should have held here at the 94.30s as A, B, and C wave down. But you could count this as a truncated top here and an ABC drop. So as long as it's going to hold 93.25, then I think it can be good to head towards 100. And then from there, maybe that extends a little bit, but probably not going to get much past the 102 level before it needs to fade again. All right. Let's see. We usually take a look at the dollar as well. Let me zoom out here. So on the dollar, I'm looking at this either as an A, B, and a C wave up at the cycle degree that could have completed at a 618 retrace of the entire move down in the dollar into the 2008 low, or off of that low could be 5 waves up as a leading diagonal. Either way, I'm looking for a pretty significant, at least fade as this purple ABC. If this is a bigger cycle ABC complete, then the move down could be even more than just this bigger ABC wave. But I'm not going to get bullish on the dollar again in any meaningful way until at least we see a larger ABC move down into the mid to low 90s. And then I would just be looking initially for a B wave bounce unless it clearly started to show signs of being more than that. Anything else that I missed or any other questions before we wrap up? Oh, Catherine says, are gold and silver mining stocks moving along with gold and silver? Are they taking a different track? I think as we were looking, the subwave count on GDX certainly looks more in line with silver at the moment. But that could just be because gold made that nominal lower low, and that it's going to fill out a similar move up for the rest of that 5 waves up from wave 1, in line with GDX and silver. We do look at platinum regularly in the metals mining and agriculture service. We have a potential primary degree wave 2 low at the September bottom. So we're looking for just the start of a larger ABC move and a larger diagonal for that primary wave 3 in platinum, but can count 5 waves up here in the C wave of the small degree A wave in that very first A, B, C up for A of an even larger A wave. So looking for a corrective retrace in the short term on platinum. I have a green 1-2 here because this first move did look like 5 waves up, but this clearly looks like it is a diagonal structure. So I'm going to go ahead and delete that because there doesn't seem any reason to be looking for impulsive structure from here. All right, I'll go ahead and get this uploaded for you guys, and I will see you next time. Have a great evening.